Welcome back to the Gold Standard. I'm Marcus Blackwell here with Sasha Reyes, and we have a packed show for you today.
Marcus, what a week! Gold just took its biggest hit since March. Silver got slammed harder, and somehow there's still a silver mining IPO popping double digits. So what's actually happening here? The market is telling two very different stories at once.
That tension is exactly what we're digging into today. Friday's jobs report came in far stronger than expected, and Kitco reported gold shed roughly 3.3%, settling around $4,353 an ounce, erasing all of 2026's gains in a single session.
Wow.
The Fed rate cut trade is off the table for now.
And yet, the ECB dropped a report this week confirming that gold has overtaken U.S. Treasuries as the largest share of global reserves. Gold at 27%, Treasuries at 22%. Here's why this matters. That's a structural shift that one bad Friday doesn't erase.
So we'll work through both sides of that. Short-term pressure from rate expectations and the longer-term demand floor that central banks keep building.
Silver's got its own story entirely, down nearly 7% in a single session. Let's think about what that volatility is telling us. StoneX flagged some real technical damage there, and Kitco analysts are raising the question, is a slide towards $60 actually on the table?
And then Bloomberg reported Sunshine Silver raised $270 million in a U.S. IPO this week to restart a historic Idaho mine. Shares up 11% on debut. Paper fear versus long horizon conviction, right there in 1 week.
A lot to work through. Let's start where the week's biggest story landed. The jobs report, the Fed expectations, and what it means for gold's structural floor right now.
Short pause.
Gold just erased every gain it made in 2026. All of it, gone in a single afternoon.
And that's not hyperbole. Kitco reported that gold futures shed $148 or 3.3%, settling at $43.5390 on Friday, the largest single-session drop since March. One jobs report did that.
So let's think about what actually happened. The Labor Department dropped a jobs number that blew past every forecast. Strong hiring, stronger than expected wages, and suddenly the market decided the Fed isn't cutting rates anytime soon.
Right. And here's why that hits gold so hard. Gold doesn't pay yield. When rate hike bets surge, real yields on dollar assets go up, and gold looks relatively less attractive. That's the mechanical relationship. It's not complicated, but the speed of this move was.
Bullion Vault's Adrian Ash framed it sharply. He noted gold erased all of its 2026 gains while the dollar surged back above a key threshold. To put this in perspective, Fed rate expectations flipped, and the market priced in hikes rather than cuts under the new Fed leadership.
And this is where I want to anchor things historically, because we've been here before. In the early 1980s, Paul Volcker was running a strong dollar policy, rates were climbing, and gold faced sustained pressure even after a major bull run. The parallel isn't perfect, but it rhymes. Strong dollar plus rising rate expectations equals a rough environment for gold.
Okay, but Marcus, I want to push on something here. Someone who bought gold in January 2026, riding that rally, is now sitting on essentially zero gains. What do they do with that?
That's the real question. And I think you have to separate what happened yesterday from why you bought gold in the first place. If you bought it as a short-term rate pivot trade, yes, that thesis took a direct hit. The pivot looks distant now.
Very distant. Reuters reported today that gold is extending losses as rate hike fears build. This isn't a one-day story. It's bleeding into the next week.
And according to Voy, analysts are flagging that negative Fed sentiment stays the main weight on prices going into next week. So the pressure isn't lifting fast.
Here's what I keep coming back to. A 3.3% drop is brutal for one session. But the important thing to understand is this. Gold was sitting on significant gains coming into this week. The January buyers haven't lost money, they've lost their gains. That's different.
Good distinction. And the important thing to understand is that gold's longer-term support structure hasn't changed. The drivers that pushed it to those highs, geopolitical stress, dollar credibility questions, central bank demand, none of those disappeared Friday afternoon.
Which is a real tension. Short-term, rates are the hammer, but zoom out and the picture looks different.
History doesn't repeat, but it rhymes. In the mid-1980s, after the Volcker shock, gold found support because real institutional buyers never fully stepped away. They were accumulating on weakness. The question now is whether we see the same dynamic.
Okay, but we should be honest. The job report didn't just rattle sentiment. It raised the actual possibility of rate hikes, not just fewer cuts. That's a harder environment, not just a pause in the rally.
Agreed. And the numbers back that up. Real yields moving higher, dollar strengthening, gold dropping. The correlation is textbook right now. What breaks it is either softer economic data or a shift in Fed signals.
So for listeners holding gold right now, here's the honest answer. The short-term macro wind is against you. The question is whether you're positioned for the short-term or the longer structural story.
And that structural story is actually where the most interesting data is sitting right now. Because while the job report was hammering gold prices, something else was happening on the other side of the ledger. Central banks weren't selling.
Right, and that raises something worth sitting with. If the biggest institutional holders of gold are still buying even as prices fall under rate pressure, what does that tell us about where they think this actually goes?
That's the question smart money is watching closely, and the answer might change how you think about this week's sell-off entirely. So here's the thing about that central bank buying we mentioned. The ECB just put out a report that gives it real structural weight.
And let's think about what these numbers are really telling us. By end of 2025, gold made up 27% of global central bank reserves, up from 20% just a year earlier. U.S. Treasuries dropped to 22% from 25%. Gold is now the single largest reserve asset on the planet.
Let that land for a second. For decades, U.S. Treasuries were the bedrock of global reserves, the safe haven, the benchmark. And now, gold has passed them.
For folks at home, think of it this way. The world's biggest institutional investors quietly shifted the pecking order, the structural hierarchy. They're voting with their balance sheets.
And here's why the historical context matters. After Bretton Woods collapsed in 1971, gold was essentially written out of the official monetary system. Countries weren't supposed to need it anymore. The dollar was the anchor. What we're watching now is a slow reversal of that assumption.
So the ECB, of all institutions, is the one documenting gold reclaiming that role.
Right. Kitco reported on it Tuesday. The ECB's annual report on the international role of the euro flagged this explicitly. And their framing was clear. Geopolitical tensions are a primary driver. Central banks want assets that don't carry counterparty risk from a rival nation.
Which explains China perfectly. The South China Morning Post reported the PBOC was the fourth largest per-country buyer in 2025, purchasing around 25 tons last year. And Bloomberg reported just yesterday that China extended its buying streak in May, even as spot prices were under pressure, buying into weakness.
Buying into weakness. That's not a panic trade. That's a strategic accumulation.
And it's not just China. Poland, Kazakhstan, Brazil were all ahead of them in 2025 buying volumes, according to the ECB data. That's broad-based demand across very different economies, which means this is structural, not a one-nation play.
The pattern holds up historically. When real yields rise and gold drops in price, retail investors and momentum traders exit, but central banks and sovereign wealth funds treat those dips as an entry point. Different time horizons, different calculus.
So the structural floor we talked about before, this is what it looks like in practice, not an abstraction. Actual tons being added to actual vaults while the price is sliding.
And the mining.com piece on the ECB report put it plainly. Gold's historic rally pushed it past treasuries on share of reserves, even though central bank buying actually slowed last year. Price appreciation did some of the work, but demand stayed consistent.
Okay, so you've got an asset where even the year of slower institutional buying still resulted in a structural shift in global reserve rankings. That's not a coincidence. That's a signal worth watching closely.
History doesn't repeat, but it rhymes, and what we're seeing rhymes pretty clearly with the 1970s reassessment of dollar dominance. Different trigger, same logic.
Here's what I keep coming back to, though. Gold is dealing with real short-term pressure from rate expectations. Central banks are buying anyway. That tension is going to resolve in one direction eventually.
The smart money is watching this closely. The question is the timeline, not the direction.
And speaking of something behaving very differently than gold this week, silver had a session on Friday that raised a whole separate set of questions. A 7% drop in a single day. And analysts aren't calling it simple sympathy selling. They're seeing something more structural at play.
StoneX flagged it as a potential shift in precious metals risk appetite broadly. Silver's dual nature as a monetary and industrial metal makes it a different story, and it's worth examining on its own terms.
That's exactly where we're going next.
Short, boss.
Now, flip that on its head. While gold was losing ground, silver got hit even harder. XTB reported silver slumped nearly 7%. Let's think about that number. On Friday, testing the $68 area and breaking back below its 200-day moving average.
7% in a single session. That's the thing about silver. It almost always amplifies gold's moves. When gold drops, silver drops more. When gold rallies, silver tends to overshoot on the upside too.
Right, so it's louder in both directions.
Exactly. That dual identity is the key. It's a monetary metal, so it tracks gold's rate sensitivity, but it's also an industrial metal, so when risk appetite tightens, you get both pressures hitting at once.
Okay, but here's what I want to know. StoneX put out an analysis flagging this as more than just silver selling off in sympathy with gold. They're calling it a shift in precious metals risk appetite broadly. Does that reading actually hold up when you zoom out?
Here's what the numbers are telling us. The technical damage on silver was worse than gold's. Silver broke its 200-day moving average. Gold consolidated. StoneX is pointing to deteriorating momentum indicators and saying silver's inability to hold leadership in this complex is a signal, not just noise.
So silver's the canary.
That's one way to read it. The metal that leads rallies often telegraphs reversals first too. What StoneX is watching is whether silver can reclaim that threshold. If it can't, they're suggesting the broader precious metals complex could face a more challenging period ahead.
And Kitco had a piece out earlier this week. Jeffrey Christian of CPM Group actually floated the possibility of silver spiking down towards $60. Now, that's a pretty aggressive scenario, and here's the important thing to understand. It's a tail risk, not the base case.
It is, though I'd frame that as a tail risk scenario, not a base case. The industrial demand for silver hasn't changed. Solar panels, electronics, EV components, that's real, physical demand with a floor under it.
Right, so the thesis is exactly what you're saying. The paper market gets spooked, the physical demand stays put, two different clocks running at different speeds entirely.
That's actually a clean way to put it. Short-term, silver tracks rate expectations and dollar strength just like gold. Longer-term, the industrial story is a separate support structure entirely.
For the folks at home trying to make sense of a 7% drop in one session, this is silver being silver, volatile by design.
Volatile by design. And that volatility cuts both ways.
Which brings up an interesting question. If silver's spot price is sliding, who's actually putting new money into silver right now? Because someone is. Bloomberg reported this week that Sunshine Silver Mining just raised $270 million in a U.S. IPO to restart a historic Idaho mine, and the stock jumped 11% on day one. That's institutional conviction speaking.
So investors are funding mine restarts while spot prices are falling. What does that tell you? So here's the irony of this week. Spot silver's down nearly 7% on Friday, and in the same week, Bloomberg reported that Sunshine Silver Mining raised $270 million in a U.S. IPO to restart a historic Idaho mine.
And not just raise the money. According to Bloomberg, shares opened 11% above the IPO price on day one. Let's think about that signal carefully. Institutional investors handed over real capital for a mine that isn't even producing yet.
So that tension is worth sitting with. The IPO priced at $13.50 per share, which was already the low end of the marketed range.
So institutional buyers weren't exactly rushing in with both fists.
Right, but they showed up. And here's what I keep coming back to. Is this smart money positioning ahead of the supply cycle turning, or is this a $270 million one-off bet that has nothing to do with where silver's actually headed structurally? Here's what the numbers are telling us. Historically, you see mine investment pick up when spot prices are depressed, not when they're at highs. The logic is simple. Build capacity cheap, produce when prices recover. That's not a new playbook.
So the cycle argument plays out like this. Investors fund the restart now while silver's weak. It recovers in 12 to 24 months, and they're positioned ahead of the crowd. That's institutional conviction speaking in real capital.
That's one read. The other read is that this IPO was priced at the low end and still needed an underwriter overallotment option on 3 million additional shares to get done. That's not exactly a stampede of conviction.
Fair point. Pricing at the floor and needing the green shoe to close the book tells you something genuine about where institutional demand depth actually sits.
And the industrial case for silver remains real. Solar panel manufacturing, EV battery components, electronics. If you believe the energy transition story holds through a rate-driven rough patch, the supply argument for a mine restart makes sense on a longer horizon.
But that's a multi-year structural bet. Someone buying this IPO isn't thinking about next quarter's Fed decision.
Right.
They're thinking about where silver sits when the physical supply deficit actually bites, when capacity comes online and demand returns.
History doesn't repeat, but it rhymes. The early 1980s saw a brutal precious metals correction right alongside new mine development being funded. Some of those projects looked terrible for 3 years before they looked brilliant.
So the honest answer to whether this IPO signals a cycle turn is we don't know yet. Could be early conviction, could be a stranded asset if rate pressure extends. The market hasn't answered that question.
What it is, without question, is a genuine signal that some investors are looking past the Friday sell-off. Whether they're right is a question this market hasn't answered. That's a wrap on this one. What a week to cover.
Seriously, gold erasing all of 2026's gains in a single afternoon because of one jobs report, and yet central banks are still adding tons to their vaults. That's the structural tension right there. That tells you everything.
And that's the real story here. Short-term rate pressure versus a structural shift in how the world holds reserves. Gold overtaking U.S. Treasuries as the largest share of global reserves, and the buyers aren't blinking.
If central banks aren't selling into the drop, that's conviction worth paying attention to. Does that make sense?
History tends to rhyme that way.
If this episode made you think differently about what's happening in the market, subscribe and leave us a review. It genuinely helps us keep complex topics accessible.
And if you've got questions, reach us at goldstandard@heymato.com. We read them.
Thanks for being here. We'll be back next week following the gold.
Until next time, follow the gold.